What if I told you that your investment strategy could mean the difference between retiring rich or working forever? Sounds dramatic, right? But here's the thing. How you invest is just as important as what you invest in. Welcome to the ultimate investment showdown with compounding wars. Today we're pitting three heavyweights against each other. Normal SIP, lump sum, and the mysterious modified SIP. Which strategy will dominate? Stay till the end, because the winner might just change how you invest forever. Imagine being Nikola Tesla in 1895. You've just invented something groundbreaking, wireless electricity. The world is on the verge of a revolution, and you're on the brink of fortune. Investors are lining up to back your vision. But here's where things take a turn. Overnight, everything is gone. Years of research, millions in potential investment, wiped out. Most people would have given up, but not Tesla. Instead of panicking, he did something unexpected. He reinvested what little he had left into his ideas, doubling down on his knowledge instead of chasing fast money. Tesla's approach was like modified SIP in investing, adjusting in hard times instead of giving up. While his investors pulled out, he found smarter ways to fund his future. And today, his innovations power the modern world. Tesla's story isn't just about science, it's about investment. He didn't have a steady SIP, nor did he throw all his money in at once like a lump sum investor. He adapted, just like a modified SIP investor does. And that brings us back to our compounding wars, analyzing modified SIP versus normal SIP and see which one wins. The right investment strategy isn't just about picking a method, it's about knowing when to hold, when to invest more, and when to adjust. If you want more insights like this, make sure to hit that subscribe button and join us in mastering the art of smart investing. Let's meet our first two contenders, SIP and lump sum. If you've ever invested, you've probably used one of these. But do you know which one actually makes you more money? Let's break it down. Systematic investment plan, SIP, is like that disciplined friend who never misses a gym session. You invest a fixed amount regularly, rain or shine, bull or bear market. The idea? Consistency beats timing. It's the classic slow and steady wins the race strategy. SIP takes emotions out of investing, ensuring you don't panic when the market dips or get overconfident when it soars. On the flip side, SIP's consistency can also be its weakness. Imagine buying a cup of coffee every day, no matter if it's on sale or overpriced. Over time, you could end up paying too much for something you could have gotten cheaper by timing your purchases. That's what happens when you blindly follow SIP without considering market trends. Now let's talk about lump sum, the adrenaline junkie of investing. Drop a huge amount all at once and let compounding work its magic. If you invest at the right time, you're laughing all the way to the bank. But if you get it wrong, well, you might be crying into your spreadsheets for years. It's a high-risk, high-reward strategy. Lump sum has one undeniable advantage. It puts your money to work immediately, allowing compounding to start sooner. But here's the catch. Most people don't have the confidence, or luck, to pick the perfect entry point. It's like jumping into a game of double dutch. You need perfect timing or you'll get tangled in the ropes. As Philip Fisher said, the stock market is filled with individuals who know the price of everything but the value of nothing. And that's exactly why choosing between SIP and lump sum is more than just about numbers. It's about understanding value. All right, let's move on to the next topic, the hidden flaws of these two strategies. Now, here's where things get interesting. SIP seems great for those who don't want to time the market, and lump sum sounds perfect for those who trust in long-term growth, but both have weaknesses. With SIP, you might invest during overvalued market periods, reducing your long-term returns. Think about it. If the market is peaking and you keep buying at high prices, you're missing the golden opportunity to buy low. A SIP investor may believe they are playing it safe, but in reality, they could be averaging up rather than down. And then there's lump sum. What if you invest everything right before a crash? Your portfolio shrinks overnight, and you're left wondering if you should sell and cut losses or hold on and pray for a rebound. The psychological stress alone can be overwhelming. Market crashes have historically caused even seasoned investors to make impulsive decisions, proving that lump sum isn't as easy as it sounds. And here's something most investors don't realize. Psychological bias plays a huge role in investing. SIP investors tend to get too comfortable and ignore market conditions, while lump sum investors often hold on to their money out of fear of mistiming the market. Either way, both strategies leave something on the table. Most financial advisors won't tell you this, but blindly following SIP or lump sum means missing out on a crucial aspect of investing: adjustability. Instead of rigidly sticking to one strategy, what if you could combine the best of both worlds? Moving forward, let's talk about the strategy that fixes these issues: the modified SIP. Modified SIP is like the elite investor who knows exactly when to push harder and when to hold back. Instead of blindly investing the same amount every month like a traditional SIP, modified SIP adjusts based on market conditions. It's the perfect balance between discipline and flexibility, something neither SIP nor lump sum can fully offer. Here's how it works. When markets are high, you lower your SIP contribution. When markets crash, you increase your investment, taking advantage of discounted prices. This simple tweak can significantly boost returns over time. And if you think a 1 to 2% increase doesn't matter, just wait until you see the numbers. Over decades, this minor adjustment can lead to massive gains. Unlike traditional SIP, where you stick to a fixed contribution, modified SIP allows you to maximize market opportunities without the stress of perfect timing. Think of it like adjusting your car's speed depending on road conditions. You wouldn't drive at full speed in a storm, right? Similarly, why would you invest the same amount when the market is clearly at a peak? Here's an uncommon insight. Historical data suggests that investors who increase their contributions during bear markets outperform traditional SIP investors by a significant margin over long periods. And yet, most people still follow the same rigid investing approach, losing out on potential wealth. All right, let's put this theory to the test with a real-world scenario with 3 investors and see who wins the compounding war. Here are 3 investors, each following a different path. One jumps in head first, betting everything on a lump sum investment, hoping to catch the market at just the right moment. Another plays it safe, sticking to a traditional SIP, investing the same amount every month no matter what. And then, there's the investor who takes a different approach, adapting their investments based on market conditions using the modified SIP strategy. Each of them commits to their strategy for 25 years, navigating bull markets, crashes, and periods of slow growth. The lump sum investor sees explosive growth if they invested at the right time. But if they entered just before a downturn, they spend years just recovering their losses. The traditional SIP investor enjoys consistency, avoiding the stress of market timing, but misses out on the power of strategic adjustments. Then, there's the modified SIP investor, who increases investments when the market dips and scales back during peaks, capitalizing on the best opportunities. As the decades pass, market cycles test their patience, discipline, and financial instincts. But in the end, when we fast forward to 2024, the investor who used modified SIP quietly pulls ahead, with a portfolio worth 10–15% more than the traditional SIP investor. Why? Because they used market downturns to their advantage, strategically increasing their contributions at the right moments. In the 1970s, a lesser-known investor, Richard Russell, proposed a method similar to modified SIP. He advised increasing investments during bear markets and scaling back in bull runs. Decades later, his clients outperformed even the best market timers of his era. This isn't just theory, it's a proven strategy. So what does this tell us? The real winners aren't the ones who blindly invest, hoping for the best. The winners are those who adapt, strategize, and make compounding work in their favor. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Up next, let's unlock the power of step-up and step-down SIP, the game-changing strategy that investors rarely talk about. Get ready, because we're about to reveal the secret sauce that could take your investments from average to extraordinary. Step-up SIP is often praised as the go-to strategy for increasing investments over time. As your income grows, you allocate more towards your SIP contributions, ensuring that you build wealth steadily. But what if there was a more strategic way? Enter step-down SIP, the lesser-known yet highly effective approach. Step-down SIP works by reducing investment amounts during high market valuations and increasing them when the market dips. It's a way of buying more when prices are low and holding back when prices are high. It ensures you're always optimizing your purchases rather than investing blindly. Think of it like shopping. Would you rather buy something on sale or at full price? Most people would choose the sale, and that's exactly what step-down SIP helps you do in the stock market. It adjusts contributions to maximize returns while keeping risks in check. By combining step-up and step-down strategies, you can create a dynamic investment plan that evolves with market conditions. It's the closest thing to market timing without actually trying to time the market. More importantly, it gives investors a level of control and strategy that a static SIP simply cannot. Instead of following the market blindly, you actively position yourself to take advantage of volatility, and that alone can be a game changer. Now let's dive into one of the most debated topics in investing: market crashes, panic, or profit. Are they financial nightmares or golden opportunities? Stick around, because what you do when the market crumbles could determine whether you just survive or truly thrive. Market crashes. Two words that send chills down the spine of many investors. But should they? Most people panic and sell, locking in their losses. But history has shown that crashes are actually the best times to invest. When stocks are trading at a discount, smart investors step in and buy aggressively. Warren Buffett calls this being greedy when others are fearful. The biggest market rebounds have always followed downturns, rewarding those who had the patience to stay the course. Modified SIP thrives in these moments. Instead of freezing in fear, this strategy increases investments when prices are low, taking full advantage of discounted assets. It's like getting premium stocks at bargain prices while everyone else is running for the exits. So, the real question is, do you see market crashes as a disaster or an opportunity? The answer could be the difference between average returns and life-changing wealth. It's not just about surviving downturns. It's about using them as a springboard to greater financial success. Now that we've seen the strengths and weaknesses of each strategy, it's time to crown the winner. But before we do, let's break it down one last time. Lump sum investing is powerful, no doubt about it. If you have a lump sum of money and the market timing happens to be right, you can set yourself up for massive long-term gains. But let's be honest, most people don't have the psychological resilience to invest all at once, especially during market downturns. Fear takes over, hesitation kicks in, and they end up missing prime investment windows. SIP, on the other hand, removes the need to time the market and ensures that you're always investing, regardless of economic conditions. It's the strategy of choice for investors who prefer consistency and discipline. But here's the downside. Since you're investing the same amount no matter what, you might end up buying at high prices when the market is overvalued. That's where SIP falls short. And then we have modified SIP, the silent champion. It adapts, evolves, and leverages market opportunities in ways the other two strategies simply can't. When markets dip, modified SIP investors increase their contributions, taking full advantage of discounted stocks. When markets are overheated, they pull back, preserving capital for better opportunities. This balance of strategy and adaptability gives modified SIP a clear edge over traditional investing methods. Think of it this way. If investing were a chess game, lump sum is the risky all-in move, SIP is the steady but predictable play, and modified SIP is the grandmaster's strategy, always staying ahead, adjusting with precision, and maximizing every move. Data from market studies backs this up. Investors who adjust their contributions based on market conditions, rather than following rigid structures, see significantly better returns over the long run. And yet, most people are stuck in the traditional ways of investing, unaware that they could be compounding their wealth much faster with a smarter approach. So who wins the war? If you have a large sum and unshakable confidence, lump sum might work for you. If you prefer stability and long-term commitment, SIP is a solid path. But if you want a strategy that combines consistency, flexibility, and maximized returns, modified SIP is your ultimate wealth-building weapon. So, tell me, after everything we've covered, which strategy fits your financial goals? Let me know in the comments. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found this video valuable, I highly recommend watching my next video, which is the perfect complement to this one. Don't hesitate to share this video, subscribe to our channel. Thanks for watching, and I'll see you in my next video.